Craig from his new office. Look at that beautiful backdrop.
Yeah, pretty exciting times for us around here in Kelowna. It's, I guess, kind of 4 or 5 years in the making, but we've officially arrived at our new location in downtown Kelowna. You can see the view behind me there. It's a little bit different than this last number of podcasts, but yeah, we're quite excited.
Is that like an elf on the shelf on the back of your... What is that?
No, the elf on the shelf is around my house every morning. Believe me, I'm told where to put it. I know it's 5:30 every morning. So that's an old stock ticker that's held by a statue. So it was a gift from a client, actually.
Let's get into it. Holiday edition, the last hurrah of 2024. Wealth Talk, episode 18. We're going to touch on where the markets are at as we head into the final stretch of the year here. The tariffs that Trump's announced and how that might impact Canada's markets and economy. We're going to look at Argentina a little bit, what's been going on down there, and then finish off with a bit of a discussion on what Mr. Warren Buffett's up to. So here we are, December 13th, Friday, lucky Friday the 13th. Markets have been performing quite well, continuing what we've seen throughout the year. Craig, why don't you give us a little bit of an update on what's happening around the world and markets and otherwise?
Certainly, it's been a pretty good fourth quarter. We got a couple weeks left before the end of the official performance year, if you want to measure it from that perspective. But yeah, it's a lot of people are probably questioning is this rally, quote unquote, that we've experienced what feels like kind of last 5 or 6 weeks since the new administration of the U.S. How sustainable this is, what that looks like as we head into the new year. In the last couple of pods, we've talked about some of the positive tailwinds that we've seen, whether that's lower interest rates, whether that's inflationary headwinds behind us. If you kind of look at, though, now that we've digested the majority of earnings in both Canada and the U.S., earnings have continued to be pretty upbeat. I think the stats that I read is that 75% of companies that reported had beaten earning expectations. Earnings growth rate is 5.5% to 6% on the quarter. Revenues were up. So, under the surface, the corporate side of things in the U.S. and the S&P 500 listed companies is doing quite well. I think that has been one of the main driving factors. And again, now that you've got the new administration and I think some of their more market-friendly initiatives that they're proposing, such as less regulation, lower tax rates, that's all supportive of capital formation. I would say that coming into 2024, I don't think anybody would expect it to see, anywhere from 15 to 25% returns on leading indices. And I think what you're seeing now as you're coming into year end, for those who are overly defensively positioned heading into this year, they're playing catch up right now. In particular, if their benchmark is the S&P 500 or the Dow or the NASDAQ, if you're a portfolio manager and you've been sitting on 25, 50 or whatever large percentage of cash, you're very likely underperforming your benchmark. So it's almost like keeping up with the Dow Joneses. I think there's some performance chasing that you're seeing right now. So yeah, a number of tailwinds. I don't think at the end of the day, it's all rose-colored glasses. And heading into the new year, we're looking at some of the risks that are out there. There is some risk with the new administration. And so again, I think we left off with a Goldilocks scenario, but Goldilocks scenario with some asterisks is heading into 2025. Maybe I'll turn it off to someone else to talk about that.
Yeah, I think obviously it's been a good market, as you mentioned, Craig. And I think just to dissect that a little bit, look at where we've come from. Obviously, the last month or so, kind of post the election in the States, where you've seen significant returns on U.S. markets. But prior to that, it's really been a market of coming out of that environment that we saw in 2022 of higher inflation, higher interest rates. And the market was pricing in far too much in the way of negatives. So as we've seen over the last year or so, as inflation has come down a lot more than expected, the market's reacted to positive surprises. And I think that's a large part of the gains that we've seen over the last 12 or 18 months. Obviously, since the election, with Trump winning the White House in the States, States. As you mentioned, the market's really in the last 6 weeks or so, kind of just prior to the election, thinking he may win, but after the election, when he did win, focusing on probably the highest probability as far as the action he may take from a policy perspective. And as you mentioned, lower regulation, less taxes. And I think that's really what the market's responded to. You used the phrase rose-colored glasses. I think that's my concern here, is that the market, to me, seems like it's really focusing just on the positives and the things that will almost likely play out: lower regulations, less taxes, and maybe being naive to the fact a little bit that there are some risks out there with his platform and his policies. One of which we've talked about, over the last few minutes, tariffs as well. So I think as we enter next year, this isn't really a bullish call or, hey, we're going to see some massive correction in the market. But I think one needs to recognize that the market corrects on average every couple of years, 10 or 20%. That's healthy. We haven't seen that for a while. We've now got a market that's really just focusing. It's very directional, focusing on the positives. And as we've seen over the last year, with markets responding to positive surprises, if there are some negative surprises that aren't priced in yet, the market might see some volatility over the next 6 to 9 months.
Let me hit on that point there with volatility, because that's one thing I was looking at preparing for this podcast. Is you're exactly right, Clark. Volatility has been so subdued over the last, let's just call it, year. When you look at something like the VIX, it rarely spiked. We saw a bit of a spike in early August. We talked about that as part of that yen carry trade and what have you. But to your point, 33, I think the stat is 33 out of the last 44 years has seen a correction of 10% or more throughout the year. So I wouldn't be surprised to see, volatility pick up as we head into the new year, because we really haven't come across much of it in, I'm gonna almost say, 2 years now.
As we always talk about, we guide and recommend, is that you don't try to get ahead of this and try to make massive market calls based on what you think might happen. We've been fortunate that we've built a really nice cushion over the last 12 or 18 months in portfolios with the gains that we've seen. We see a little bit of a setback, as I said, maybe the market just being a little bit ahead of itself here should be expected and healthy. And if anything, hey, it chips away at some of the gains that we've seen over the last couple of months.
Yeah. What about, Jay? Maybe you can touch on this. What are your thoughts on the other I guess, bearish commentary about valuations that you see right now, in particular across some of the mega cap, the magnificent seven, as they call them? What are your thoughts there?
Yeah, I think I don't know if you saw the note from our institutional desk this morning talking about forward returns when valuations were higher than 20 times earnings on the indices. Typically, forward returns for the next 5 years are lower, and that's just kind of mathematical fact. When you've got high prices and high valuations, you tend to have lower forward returns. Conversely, and going back to Clark's point about kind of trying to put money to work, when you do see some of that volatility, when you enter the market at a lower valuation, your forward returns are always going to be should be higher. And that tends to be the case. So I think another kind of just reason to be a little bit cautious and not overly optimistic. We've had 2 really strong years coming out of 2022, and we saw a pretty healthy correction that year. And whenever you see the market up as much as it is over these last 2 years, you have to be just a little bit, I think, aware of how far we've come. And I think as portfolio managers, it's our job to look kind of through those valuations to try to find where those opportunities really are. That being said, and talking out of both sides of my mouth a little bit here, the companies that are valued as highly after these last couple of years are the ones that are producing, the best revenue growth, and they are producing the highest free cash flow. The big tech names, even despite all the investments they're making in AI, are really continuing to just knock it out of the park from an earnings and growth perspective. So, we want to be kind of participating in the current trends, but also looking for the next emerging trends and really allocating capital to where we see the best opportunities.
What we always do from a portfolio management perspective, to some degree, is take a barbell approach where we do have, really good exposure to some of those names that are highly valued right now. But we're seeing, as you mentioned, Jay, a lot of revenue growth. They're in the AI space, companies like Microsoft, Amazon, Google, et cetera. But on the flip side, we also, take some of our portfolio management assets and look for opportunities more on the value side, of which there are many these days.
Yeah. That's again on the positive side of the argument. Over the last 2 quarters, you have seen a bit of this rally broadened out. It's not just specifically geared towards the mega cap names. You've seen that, and that's where, from the valuation side, I think the top 10 S&P 500 names are trading at 29 times forward earnings. That's not cheap by any stretch, but the other 490 at the end of November are trading at 19 and a half times. So there's opportunities outside of those mega cap names. And again, that's where I think stock picking comes in, a good portfolio management, looking for those opportunities.
When we're talking about, how far the market's come, if anything, what we're not calling for massive correction of any means, but I think just setting expectations that things don't go up this strongly forever. And, generally when a correction comes, you don't see it coming. The catalyst you don't necessarily recognize. Sometimes it's a snake that you don't see that bites you. But I'm curious, one of the things we've talked about, so far on this pod is Trump and his tariffs. And that seems to be a risk that's out there. I'm not sure if the market, as I mentioned, I think the market's maybe naive to the fact that there are some risks out there, that being one of them. So just curious on your view on that.
I mean, I think Trump, as always, he's going to have a louder bark than bite. And we saw that the first go around with his attempted tariffs on Canadian steel, which kind of were announced, came out really strong, and within a year were basically completely repealed. If Trump does follow through and raises 25% tariffs on everything they buy from Canada, really what that means is all of the energy that they consume is going to go up by 25% in terms of cost. And that's going to create nightmares for him from a support perspective. And I don't see it happening. I mean, he can make all the claims he wants, but he's not going to raise everyone's energy bill by 25%. And I think Canada, there's a lot of concern here about that becoming reality. But unless you're an oil exporter, now they're talking even, I think, more concerningly, Doug Ford coming out and saying that they're going to not even sell energy to the US and kind of see what happens. And if you're an energy exporter, I think you'd rather be facing the tariffs than not being able to sell your goods at all. So kind of not a healthy tit for tat, I guess, is the way I would put it.
I think, Joe, as you mentioned, his bark's louder than his bite. I think if we look back in his previous administration, that this is, and even in the business world for Trump, this is his negotiating tactics, throwing something out there completely that he doesn't necessarily want, but is it's a threat that makes people react to get something else that he wants. And I think a lot of his threats on tariffs to Mexico and Canada were really about border security and, not necessarily an economic thing. And you're absolutely right. He doesn't want an increase of every product being imported into the States having a 25% price increase with tariffs. That creates a huge other problem for him as well. So I think, when we see the reaction that the Canadian government has had, both federally but all the provinces, in the last couple of weeks addressing border security, it's been huge. And I think that Canadian government, provincial governments are taking him seriously. But I think when we look at how the market's reacted to date, and maybe we can discuss this, like a view on, is the market thinking these tariffs are going to go through, or is the market not? And I think if you look at what our, two largest exports are to two of our largest exports to the United States, as you mentioned, energy, but also forest products. If you look at the stocks in those sectors, they didn't really budge post-election. Maybe they're down a little bit. But I think when you look at those sectors, to me, it seems like the market is not pricing in that these tariffs are actually going to play out. But curious on your views.
I would agree with that. So far, I dare say it's been a nothing burger, but it really hasn't had a material impact on equity markets. Maybe where it's showing up a little bit more on the Canadian side is what's happening with the Canadian dollar. And I think even this morning, as we talk about it, we're at risk of moving into the 60-cent range, 69 and some odd cents today. So I think that's maybe where it's showing up. But yeah, at the end of the day, it all remains to be seen. It's all talk right now. No one knows what that looks like. So I think the market's viewing it that same way right now. At least the equity markets have, and the bond markets really haven't taken much of a cue from it either.
Craig, on the currency markets, I think you're right. I mean, the Canadian dollars, you know, declined quite significantly over the last 3 to 6 months versus the U.S. dollars. U.S. dollar. I'd argue though that that's not really driven by tariffs. I think that's driven mostly in the short run by interest rate differentials. You've got the States where the economy's firing on all cylinders still. Things are going very well. You mentioned earlier corporate profits are holding up extremely well, coming out of an expectation where we might see recession in the States. And obviously the opposite's happening. And the Federal Reserve, you know, has come out and actually indicated that maybe interest rate cuts to the magnitude they originally thought are not needed. You know, on the flip side here in Canada, the Bank of Canada, another 0.5 point cut this week. They've been far more aggressive on the interest rate, cuts than the Federal Reserve in the States. And, you know, if you look at a 10-year Government of Canada bond versus a 10-year U.S. Treasury bond, we're significantly lower. And when that occurs, you just see capital outflows out of Canada into the United States. And I think, you know, that, you know, based on what we have seen with interest rates, but also a forecast of what may continue to happen with interest rates on a relative basis, is the primary driver. Now, does the threat of tariffs work into interest rate expectations in the currency? I think a little bit, but I'd also argue there that, you know, the currency is not necessarily thinking that we're going to see huge tariffs as well.
So yeah, it's all it's economic numbers that we've seen over the last while here in Canada. GDP continues to contract. Like I think we're at 1% growth rate. That's lower than what was expected coming into this year. Our unemployment rate continues to actually move higher. Big reflection of that is immigration. Foreign capital, as you talk about, Clark, if you're looking at, you know, where you're going to invest, whether it's Canada or the US, with the proposals that are on the table with the new administration, with lower corporate tax rates, in addition to lower personal tax rates, capital is going to flow again, like we've talked about, where it's most efficient. And you're not seeing that confidence in the Canadian marketplace. You're not seeing that confidence in the Canadian dollar.
I think you're absolutely right, as you've got a government or an incoming government in the United States that's made it very clear on less regulation, lower taxes. One thing you didn't mention is smaller government. I look on this side of the border, you know, currently with the, the government that we have here, the opposite is what's playing out and expected to continue to play out. So I think you're absolutely right there, where you have a government that comes in and, at least what Trump indicates, that he and his administration want to make some of the tough choices that may be necessary. I think you have increased interest in a country like that.
Well, tough choices. Jay, I think with the three of us were talking about this last week or before. Argentina is a prime example of a new government that's been in power, quote unquote, for the last, I think, year now. Milei out of Argentina, who's done a complete 180 for an economy and country that was falling apart, and he made some extremely tough decisions. And look what's happened to Argentina. Very similar playbook that you're hearing within the new administration in the U.S. And I think a lot of these countries that are seeing a turnaround, it is smaller government, less regulation, et cetera. I don't, Jay, you got any comments on that? We talked about it recently.
Yeah, so I mean, the difference between, I think, as Clark points out, you know, the direction that Canada is going from a taxation, regulation, and size of government compared to the U.S. is really going to be the bigger determining factor in terms of how our markets and economy kind of perform over the next 4 years. And, you know, this Argentina story, I think, is just a perfect kind of counterbalance to what's going on up here in North America, where, like you said, we had a change of government, and those hard decisions, those kind of, right sizing of what the government's actually doing were taken to an extreme that we haven't seen in some time. So I've got a few of the kind of points that were I think are important to recognize in Javier Milei's 1 year of administration. He was basically handed an economy that was suffering from inflation at I think it was like 1,500%. So out of control inflation. GDP was declining, and he basically came in, and in the first 12 months, what he's managed to accomplish, he slashed federal spending by 32%. He reduced government industries from 18 to 8. He removed 50,000 government employees. Obviously, hard decisions to make. He's changing the way the government's operating in a major way. After 12 months, core inflation went down. It's now sub 2% on a month-over-month basis. Real wages are growing, so we're seeing employment growth that they haven't seen since 2008. GDP is already recovered, so when you're making these tough decisions and tough choices, you'd expect there to be a pretty significant economic impact. Kind of the idea that things are going to get worse before they get better. Already, though, in just 12 months, they've already started to get significantly better. And not all data is all rosy and positive. The poverty level has ticked higher, so that's a concern. But they just recently, last week, announced their first budget surplus since 2008. And going back to the idea of where capital is going to flow, investors are recognizing what's happening in the positive developments in the stock market. I mean, we talked about North American stock markets being up as much as they are this year. Their stock market's up over 60% this year. So you can see where there's an interest in the potential that economy has, and that's, I think, a key point that we've kind of touched on over the last couple of years is despite Canada's kind of malaise and lacking economic output, there's so much potential here. And actually, Argentina has so much similarity in terms of what they do in Canada's economy in terms of being resource rich, and there's so much potential if they can kind of get the government out of the way. So it's an interesting story to keep an eye on. I think there's no doubt going to be some bumps along the way as more of Malay's kind of policies and impacts of those policies come to light. But yeah, really interesting stuff happening.
I don't know a lot about Argentina. I've been there once. They've got good wine. They've got a really cool way of cooking steaks, really nice steaks, actually. And but I think, what I do know is they've been the economic basket case, really, of South America, or one of the economic basket cases over the last couple of decades, with, as you mentioned, huge inflation, huge unemployment, government turmoil, year over year. And what you've seen somebody that's come in that is bold. He's not making all the right choices. A lot of them, I think, are extreme, but he's making some bold choices that a lot of us could argue are needed. And they're not just needed in Argentina. They're needed in other South American countries. They're needed here in Canada. They're needed in the States. They're needed all around. And I think, one of the risks to some of the other economies out there, some of their neighbors in South America, but I'd also argue in Canada here, that if you have other economies that are making those bold choices and you're seeing capital flow into them, that's competition to us. And I think, again, neighbors in South America or even us, it may actually just force our hand to kind of follow suit and make some changes to remain competitive to countries that aren't, or that are. And if Trump does do part of what he indicates doing, lower corporate taxation, smaller government, less regulation, as their predominant trading partner and their neighbor next door, we're going to be forced to make some changes that are bold like they are, or else we're going to become far less competitive than we are today.
That's at the end of the day, that's extremely attractive. When you talk about with the new administration in Argentina, that's attractive to private capital. That's attractive to private investment and private ingenuity. And I think those bold decisions, people are hesitant in Canada on the private sector to go out and stick their neck out and make some of those tough corporate calls, because the other side of it, in the public sector, talk about budget surpluses and deficits. I think they just announced that our budget deficit is going from 40 billion now upwards to potentially $60 billion. Tough decisions need to be made if we're going to turn around the issues that we're facing in Canada.
Yeah, I think the real thing to kind of watch here, and where Canadian real GDP continues to decline. So, the average standard of living is actually declining here in Canada, despite having seen some GDP growth. And the notable data point, I think, from Argentina that's really interesting is real wages are growing. So people are becoming, wealthier in the over the course of time based on the earnings that they're generating for themselves. And really what you need for that to happen is a currency that's stable, that's realizing inflation that's lower than the growth of the economy. And that's something where, going to your point, Craig, about the upcoming federal deficit that's expected to be announced on Monday, you just can't continue to run growing and increasing deficits and printing money to cover those deficits and expect prosperity to come out of that. So hopefully Canada is kind of paying attention, both to what's going to happen in the US and what's happening in Argentina in terms of, the government being a little bit more sensible and creating the best environment possible for businesses to do well and for investors to do well at the end of the day, which is what we're all kind of aiming for.
And I think that's an important fact, your point. You want to be positioned if you start to see signs of a turn, and that's the outcome of that's probably a new government here in Canada. But you want to be positioned for that hopeful and potential upleg for the Canadian economy, and that will be reflected in Canadian equity markets before that. So that's why, again, people say, why are you just 100% invested in the US and if you seem to be bearish on Canada? That's not the case at all. We want to be positioned for that. And within portfolios, there's still great opportunities in the Canadian equity markets. And, it's still a balance for that. But again, we as portfolio managers need to be aware of that on top of it, make sure that we're positioned well if we start to see a turn in confidence for Canada.
Yeah, a reminder, and I think we talked about this on our last podcast or 2 times ago, is that these changes happen when we least expect it. And as you said, Craig, is that the market tends to price us in beforehand. And I'll remind people again that it was 1998, 1999, after a 10-year period of huge boom in the United States. The last part of that driven by the dot-com boom. Great economy. Canada was suffering. And I remember those conversations in 98, 99. Nobody wanted to own Canadian investments. We had a suffering currency. Everybody wanted to be fully exposed to the United States, and particularly internet-related stocks. And when we least expected it, that was when Canada entered a period of significant economic boom from 98 to about 2012, 2014. Well, at the same time, the US market went sideways for, I think, 14 years, 98 to 2012, at a time when people least expected it. And, that's not our call. We don't think things are going to turn around immediately, but it's a reason to remain diversified. And given that this is our home country, we're always going to have a bit of a home country bias. Remaining invested in Canada, we've got some great companies, and the fortunate thing is, a lot of them are extremely attractive from a valuation perspective.
Switching gears a little bit, but I think along the same kind of vein is a lot of talk recently about what Mr. Warren Buffett's been up to in Berkshire Hathaway with recent sales of Apple and his or not all of his Apple, but one of his bigger positions. He's been trimming quite aggressively in Apple, and then some other sales that he's been doing recently has raised his cash position at Berkshire Hathaway to almost 30% of the portfolio. I wonder what we can make of that, and kind of what it might be telling us about his views on the market.
Unless Buffett and Berkshire is doing something that they don't normally do, which is making large market and economic calls. And I think every time we see something like this, like their cash position elevating, making a huge investment in something, people tend to think that he's making some large macro call. And as we know, like I said, unless there's something we don't know about him and Berkshire, is that generally these decisions are bottom-up decisions, meaning looking at company by company rather than making a call on the market or the economy. And with Bank of America and Apple, and those were his two of his largest positions, Apple was by far his largest position. He's reduced that, I think, by 50%, and he's completely out of Bank of America. Just as a result of those decisions, his cash has ballooned quite significantly. And those, from what I understand at least, were not calls on the economy, calls on the sector. Bank of America was simply a call that they were having some credit issues, and he had communicated to management in his latest letter that he was not satisfied with that, gave them a lot of signals, which he normally doesn't do, and he didn't think that they were actually taking action, and he voted with his portfolio and sold the entire position. That's my understanding. Apple, similar to any portfolio manager where you have such a large stake in a company and you see the appreciation you do, you then run into concentration risk. And, taking 50% off the table, he still has a significantly large position in Apple. So it's not a call on Apple, I think. It's a risk management decision from a bottom-up perspective. It's resulted in more cash. But what you've also seen, and it hasn't got the right amount of headlines relative to his sales, he's increased positions or taken new positions. One of them is Domino's Pizza, for example. And so he's not making a call to get out of the market, I don't think. He's just shifting from a bottom-up perspective.
Well, it's interesting if you look at his positions that he actually has added. I mean, going back to the idea that we're not necessarily focused on I think we touched on this in the last podcast on the whole AI theme, and everyone is overly excited about this. Valuations are pressing, to the extreme in some of these themes. You look at what Warren Buffett's doing with some of that cash: Domino's Pizza, Pool Holdings, Sirius XM. You look at those valuations of those companies, and they're extremely attractive, significantly cheaper than the broad market. So what he's really doing, and we emphasize this over and over again, is looking at companies that are trading at elevated valuations and trimming and selling those and redeploying that capital to more attractive companies that are trading at potentially discounts with brighter futures ahead. Again, just tying into the comments we made earlier in the pod with market valuations higher, you're always going to get better forward returns buying when valuations are depressed is what we try to kind of do time and time again. So Buffett definitely following some of those kind of maxims that we try to stick to as well.
Yeah, he still owns 300 million shares of Apple. Like, it's still a $75 billion position within Berkshire. All due respect to Mr. Buffett, he's the icon of American investing. Since he sold his position, Apple's up 25% on an actual performance basis. So again, I don't think it's a call on Apple's a good or a bad company from Buffett's perspective. It's a rebalanced portfolio that went from 50% weighting, as you said, Clark, to now a 26% weighting. So it's just good portfolio management, and sitting on cash waiting for that opportunity. That is right up Buffett's playbook, right? We do the same thing. We've trimmed Apple throughout the years. We've trimmed Amazon. We've trimmed Google. It's not a call that the company's good or bad. It's a great company still. It's a reallocation of capital and prudent portfolio management when a valuation or position becomes too high based on our process.
And we're going to wake up one day and he's going to announce that he bought some massive company and all that cash will be put to work in, the blink of an eye. So I don't expect he'll be sitting on that much cash for that long. I think that's a good place to call it. We've got the holidays coming up, so I want to wish everyone a happy holidays. Hopefully everyone takes some time to get together with their families and step away from the markets, and we can pick things back up. We'll probably have a early January get together to see what we can make of the year ahead and reflect on the market calls we all made at the start of the year, see who was most right and wrong. So that'll be always a fun one.
Happy holidays, best of season, everybody. Thanks for tuning in, those who do. And again, we've always said we welcome your feedback. We always try to improve and enhance what we're doing here. So between now and the end of the year, make sure you take some time to sit back and unwind. Spend some quality time with family, whether that's up at the ski hill, at home, but try to detach from everything and enjoy your family time. But thanks to all of our clients, and thanks to you guys as well. It's been another good year.
Great. That's a wrap.